Hello everyone, my name is Anjani Kumar Khetan. I'm based out of Bangalore, and in this particular video, we will continue our deliberation from the last week, and we will continue to look at what are the key issues which are dealt with in respect of levies under IFRIC 21 and Appendix C to Ind AS 37. That is something which I just introduced this concept to you in the last week's video. So we will continue. And just to recap, we have already seen this particular slide where I told you that these are the 6 key issues which are dealt with by IFRIC 21 and Appendix C to Ind AS 37. If you have not seen the video of the last week, I would encourage you, if you can go through the last week's video, that will be helpful because this is a continuation of the last week's discussion. So in this video, our focus should be to look at these 3 issues which are how they are dealt with under IFRIC 21. And in the next week video, we will look at the other 3 issues with the help of case studies in each of those cases. So with that said, let us first look at the first issue, this one. What is the obligating event which gives rise to the recognition of the liability to pay a levy? Let's see this. What is the obligating event? Now, if you look at the interpretation, IFRIC 21 and for that matter even Appendix C to Ind AS 37, it says that the obligating event that gives rise the liability to pay a levy is the event or the activity which triggers the payment of levy as identified in the legislation, the law or the regulation which is actually levied the levy, which is the source of that levy. So you got to look at under the law, under the legislation, the rule and the regulations, what is the cause or the source of the levy? In my example, which I said in the previous video, let us say the levy could be generation of revenue in the current period, or it could be production. If you are making production in the current period, that can be the basis for the levy. Or it could be you continue to remain in the business in a particular area. So for example, if you are in a banking industry, the last week I told you the UK banking levy which is there. So in a scenario like this where you have a banking levy, the banking levy is in respect of if you are in the banking business, if you being a bank, if you continue to be in that business, then you may be subjected to a levy at a certain percentage based on the specific criteria, which is part of the legislation. So basically, what the first issue tells you that the obligating event, the guidance given in IFRIC 21 and Appendix C is this, that the obligating event which gives rise to a liability to levy is the event which actually triggers the levy, which is identified by the legislation. So for example, if the activity triggering the payment of the levy is generation of revenue in the current period. So for example, in the current period, if you start generating revenue, then the trigger happens. Trigger of the payout happens. The liability gets started at this point in time, the moment you start generating revenue in the current period. However, in this particular case, we are saying that yes, the liability may get triggered here in the current period, but the calculation of the levy is based on revenue generated in the previous period. That means whatever revenue you have generated here, a percentage of that will get paid here. But for the liability to get triggered, you must start generating revenue in the current period. This is the fact pattern. If this is how the legislation is, the question is, what is the obligating event? Is it that you have had revenue in the prior period or in the current period? What is the obligating event? So the guidance given here is that the triggering event in this fact pattern is the generation of revenue in the current period, not this. The generation of revenue in the previous period doesn't matter. It is a necessary condition but not sufficient condition. For the levy to get triggered in the current period, you must start generating revenue. So for example, if the entity was there in the previous year but is not generating any revenue in the current period, then the legislation does not trigger any levy. So therefore, what the standard tells you, what the guidance or the interpretation tells you, that in a scenario like this, triggering event is the generation of revenue in the current period, and the quantum, of course, is based on the revenue generated in the previous period. So the quantum of levy is based on the revenue in the previous period. So how much you pay is based on the revenue of the previous period. But the liability gets fastened only when the generation of the revenue is happening in the current period. So this is exactly what is explained in this particular piece. So what the guidance tells you, that if you have a scenario like this, then the guidance is that the obligating event is generation of revenue in the current period. This is the triggering event which causes the levy to get fastened. So the generation of the revenue in the previous period, this period, is necessary but not sufficient to create a present obligation. Let us see a case study to explain this point in more clarity, with more clarity. So I brought forward whatever was the discussion here or the key guidance given in the the interpretation I brought forward. Let us see the case study. Consider a scenario where City Corp, reports annually on 31st of December. So basically 31st of December each year is their year end. A levy is triggered, see here, in full. The levy gets triggered as per the law in 100% in full as soon as the entity generates revenue in 2021. So at any point in time in 2021, when the revenue is generated, the levy at 100% gets triggered. Did more. However, the levy is calculated based on a certain percentage of the revenue generated by the entity in this year, 2020. The entity actually generated revenue in year 2020, and so basically, let me clear this. What it says, in this year, you have actually generated revenue. That's what it says. And in year 2021, in the current year, it starts to generate revenue on 3rd January. This is 1st January 2021. On 3rd January, at this point in time, on 3rd January 2021, the revenue gets started for year 2021. Let me pull up the slide on the slide. You can see on 3rd January 2021, the case study tells you that the entity starts generating revenue for 2021. Now, considering all these fact pattern, your liability gets triggered in full, 100% on 3rd of January 2021. Of course, the quantum will be on the basis of the revenue which you have generated in the last year. So, triggering event, the levy gets triggered in this case on 3rd of January in full because of the fact that generation of revenue happens on 3rd of January related to the current year. Of course, the quantum will be based on this year's revenue. So, the net outcome of all of these is the obligating event in this particular case is the first generation of revenue in year 2021, which happens on 3rd of January. The moment you start generating the revenue in 2021, the obligating event gets triggered and your liability gets fastened in full, 100%. So, the generation of revenue in 2020, I have already told you, is not the activity which trigger. This revenue in this period does not trigger the liability. The liability gets triggered when the revenue gets generated in year 2021. Right? So that is how you have to read the requirement of this standard. So what is the moot point? The bottom line is this, that in a scenario like this, the liability for levy is recognized in full on 3rd January when you start the generation of revenue. So it's a point in time levy. In this case, it is a point in time. 100% of the levy will get triggered onto you on 3rd January. So the entire amount will be payable on 3rd January itself, relating to the revenue which you have earned in the last year. So this is issue number 1. Let us say issue number 2. What is the effect of economic compulsion on the liability? So the question here is whether the economic compulsion to continue to operate in a subsequently future period, does that compulsion create a constructive obligation to pay for a liability or a levy that will be triggered by operating in a future period. What does it mean? So, simply stated, what basically the paragraph 9 tells you, that let's say you have operations in this period, but if the levy is triggered because of your future period operations, it says, even if you have an economic compulsion, let's read it, what paragraph 9 says. Paragraph 9 says, an entity does not have a constructive obligation to pay levy that will be triggered by operating in a future period as a result of the entity being economically compelled to continue to operate in that future period. That means even if the entity is economically compelled to operate in this period, in these previous periods, there is no way you can conclude, as per the way IFRIC 21 exists today, that in this period, the fact that the compulsion is there to operate in this period, still the liability is not there in this period. Liability gets generated or gets fastened only at this point in time. So, to this question, whether economic compulsion creates constructive obligation? No. That is the answer which is given by paragraph 9, the way it stands today in IFRIC 21. Now we will see when we go to the amendments what changes are brought in by the proposed amendments that we will see in later part of our video series. But as the things stand today, IFRIC 21 and Appendix C does tell you, even if there is an economic compulsion to continue operating in future period, it does not give you or does not create a constructive obligation. Moving further, let us see a case study. Consider a scenario where Citibank, this is the Citibank, their reports, again, they have December 31st as the year-end date. So December 31st, December 31st. This is their two year-end dates. A levy is triggered. This is similar to what I just explained, that United Kingdom banking levy. It is something like that. So a levy is triggered if the bank is operating at the end of the annual reporting period. Let us say if the bank operates at the end of this period, 31st December 2021, then as per the law, the levy gets triggered at this point in time. Further, the levy is calculated based on the total equity in the bank's balance sheet at the end of the annual reporting period. So, if you are operating as a bank on 31st of December 2021, in my example, then depending upon what is your total equity at this date, 31st December, a percentage of that is the levy. That is how the legislation is there. So in that case, consider the end of the bank's annual reporting period, in my which I said is if it is 2021. What is the obligating event in this case? So clearly, the triggering event in this case, based on the fact pattern which are given here, is that on 31st of December 2021, entity should operate as a bank at the end of this particular date. And if they do operate as a bank on this date, then levy is triggered on 31st of December. And the basis of the payout will be total equity at the end of this period. So the quantum computation of levy would also be based on, in this fact pattern, total equity on 31st of December 2021. So in this case, if you look at what is the bottom line, look at it here. So obligating event which triggers the payment of levy in this case is essentially the bank which is operating at the end of the annual reporting period, which is 31st of December 2021. And before this point in time, before 31st December 2021, entity has no present obligation to pay the levy, because the levy gets triggered only when you are operating as a bank on 31st of December 2021. Even if bank is economically compelled to continue to operate in future, it doesn't matter. The way the standard or the interpretation exists today, it tells you that this economic compulsion has no meaning. The liability will get triggered when and only when you are operating as a bank in this case on 31st December 2021, because that is the triggering event that you must be operating as a bank on the specified date, which is 31st December 2021 in this case. And then only the liability gets triggered. So this is also a point in time. Here also, the liability will be recognized in full on this date. Again, it's a point in time recognition of the liability. Right? That is how you have to look at and understand issue number 2, how the interpretation has addressed this particular issue. Now let us go for today's discussion. Let us go to the last issue for the day, which is effect of going concern assumption. So, what is the issue which is addressed by IFRIC 21? It says whether, this is the issue addressed, whether the going concern assumption imply that the entity has a present obligation to pay a levy which actually get triggered as per the legislation by operating in a future period. So, in the future period, if you operate, the levy gets triggered. But the fact of the matter is you are a going concern. You are a going concern. You are expected to operate in future period also. Will the fact that you are a going concern, whether that creates an obligation to record the liability? Let us see what it says. Again, answer is no. As the things stand today, IFRIC 21, paragraph 10, and for that matter, Appendix C, Ind AS 37, paragraph 10, tells you no. This going concern assumption has no bearing on the present obligation. Because in this case, how paragraph 10 reads it out, it says, the preparation of the financial statement under a going concern assumption does not imply that the entity has a present obligation to pay levy that will be triggered by operating in a future period. So example which I gave. If you are preparing the financial statement as a going concern here, but if the levy is triggered because of your operation in future, the fact that you are preparing the financial statement on a going concern basis, it does not create present obligation. That is how the standard reads today. That is how the clarification tells you today. Things may change. When we go to the amendment, we will look at it. Okay, so this is what the guidance today is. That no, going concern assumption does not create a liability. So, IFRIC 21 is clear that only those obligations which arise from past events which exist independent of future activities of the entity should be recognized as a provision. Now, tomorrow the entity may discontinue its business, and therefore anything which refers to the future activities, they are saying should not be recognized as a provision, because the trigger of the levy in the example which we have is based on actual operation in the future period. So, the going concern assumptions cannot lead to a recognition of liability which does not meet the definition of and recognition criteria of IAS 37 and Ind AS 37. This is the guidance currently which is there under IFRIC 21 and Appendix C. Let's see this with the help of a case study. Consider a scenario wherein a legislation requires an entity to pay a levy if it owns a property on 31st of December. If this happens to be your year-end date, so the way the law requires it, that you need to pay that a levy if you are owning the house or the property at the end of 31st of December, then the levy gets triggered. That is the first point. So the legislation requires an entity to pay a levy if it owns the property at this date. And in that case, the property tax payable is 1% of the most recent property valuation payable by the owner on 31st December. That means you will pay here 1% of the valuation, most recent valuation. And what is most recent valuation? Given here. And the most recent, let me clear this, and the most recent property valuation is from 30th June of the same year. So that means in this period, on 30th June, let us say if you have the valuation. So 1% of the valuation is payable on this date as per the legislation if you own the property on 31st of December. This is the sum and substance of this case study. Right? So in that scenario, what will happen? So in this case, the obligating event, as we have seen in the earlier two case studies also, is the ownership of the property on this date. That is the real triggering event as per the legislation. Property owner has no present obligation to pay the levy during the year until this date gets achieved. And on this date, the entity should have the house ownership or the property ownership. So the property owner has no present obligation during the year until it happens that he is actually the owner at the end of 31st of December to pay during the year, even if he expects to still own the property on 31st. Even if during the year there was no reason for the entity to believe that this property will not be owned by the entity, still in this period, no present obligation is there. That is what the guidance currently is in IFRIC 21 and Appendix C. Therefore, why so? Why currently the guidance is? Because the owner can sell the property before 31st of December. If you are saying at any point in time, technically the property owner can sell this property and get rid of it before 31st of December when the levy is triggered. Or maybe it is possible that the law itself changes by this time. Okay, and therefore the liability is again recognized at a point in time on 31st of December, this date only. This is the way currently IFRIC 21 and Appendix C gives the guidance. Thereby meaning that the date of the property valuation, in this case, this date, is irrelevant. It is only used to measure the liability. This is not is not a sufficient condition. It is a necessary but not sufficient condition. The requirement for the levy to get triggered is the ownership of the property on 31st of December. So this is what I wanted to cover, the first three issues which are dealt with by IFRIC 21 and Appendix C. Now in the next video, we will continue and cover the other three issues which are dealt with by these interpretations. So the series will continue. We will continue, and now in the next video, we will conclude our deliberation on the current version of IFRIC 21 and Appendix C to Ind AS 37. After we conclude these in the next week's video, then we will go back and go to look at what are the proposed changes which are on the anvil for these guidances, because the guidance, there is an exposure draft which requires certain changes in the way this accounting is to be done. So we will continue this effort and series will continue. So that's what I wanted to cover for this particular video. As usual, this is the list of some of the useful videos which are there on my YouTube channel. This is the link of the YouTube channel. If you want, you can scan and subscribe to the YouTube channel. You can share, provide comments. If you need any specific topic which you want me to cover, put it in the comment box. I will try if I can address and create videos on those topics as well. But this is what I wanted to cover for this particular video. I will take a pause and I will continue to remain engaged with all of you. Bye for now. Take care. Thank you.